I spoke with someone on Saturday morning. We raised $6 million from that one person for a whole deal that we were doing, this preferred equity deal. And then I got off that, this is like 7:30 in the morning. I got off that call and I got a text from the president of our management company. And he's like, I got a call 5:30 in the morning that the sprinkler went off at this hotel and flooded rooms on the third floor. 15 rooms are like totally soaked. We have the remediation company coming in there. The good news is that it was only on the third floor and that the rooms below weren't damaged. Only the meeting space was damaged. The bad news is that I think our deductible is $500,000 and it's going to be well under $500,000. So we're going to have to, pay to fix all this crap and blah, blah, blah. So I'm like, that's the hotel business. You get the highs and the lows. You get, we get kicked right in the privates. I'm going out of town today, actually. I'm going to a hotel that I was told is the best hotel in Europe by someone who knows great hotels. It's called Estelle Manor, and it's worth probably looking up. I can pull it up right now, but I think it's very relevant to where I see the permanent shift of hospitality going. And that is in experiential lifestyle products, very immersed in nature, very immersed in design and food and culture. So this is in the UK. It's about an hour and a half outside of London. It is a former manor house, and it is a private members club as well as a hotel. And they have a ton of like wellness stuff. So they have these Roman baths, they have all the cold plunges, they have a bunch of activities like padel and workout and fitness. And let's see, they have a kids program, which I also think is a really big deal. They have farm animals, and it looks kind of amazing. Obviously, yoga. Here's the padel, all indoor, outdoor. And I think the best time to go is in summer. I'm going to be going when it's a little cold, but I live in a warm place, so it'll be fun to be there. And I'm excited to see this. I was having a conversation today with one of my investors and advisors, and I was at the lodging investment conference in California last week, and I was giving her a rundown of my takeaways. And one of the takeaways is that most of the people there, whether they were a owner operator, an investment firm, maybe a management company, they didn't have a lot going on. There was like no deals. There was no opportunities. There was nothing people were talking about sharing that they were doing. And if you contrast that to 2 years ago, we had private equity firms walk around like they were too cool for us. They didn't need us. They've got their own deals. They've got plenty of deals. They've got plenty of money. Now, all those guys were interested in the deals that we had. One deal that we were talking to a few people about, and it was a small deal. It was a preferred equity deal at a boutique hotel in Savannah, Georgia. And everyone was interested in the deal, despite how small it was. And normally these big private equity firms are not interested in a small deal because they have too much money to put out, and they're going to spend the same amount of time on a small deal as they are on a large deal. So if they are focusing on a small deal and they're only going to get a return on investment that's like $6 million, it's probably too small because their fund is too big. But what we were pitching and what we were talking to them about is that this could be the start of a larger relationship, and that these small deals are actually an opportunity because all the big funds are focused on bigger deals, which aren't even there, but they're focused on these big deals. But the opportunity is in some of these smaller deals. And if you could cobble together a bunch of small deals, they add up to a big deal. And small deals can potentially turn into a big deal in and of itself. You can always expand. Maybe we were doing preferred equity, maybe we buy out the common equity. And that really resonated with a lot of folks. And during kind of the COVID era in our first fund, we did about $60 million of deals with one private equity firm. and they were like $7 to $11 million. And a lot of groups didn't see those deals because each individual one was too small. This group bet on the relationship and bet on the repeat opportunities to do more deals. So I thought that was interesting. And I think it's relevant for this group because cobbling together smaller opportunities and building a collection is a pain in the ass. So, I mean, you could look into other business lines. So, like, everyone was talking about buying these small businesses like veterinary hospitals and heating companies and plumbers. If you're the guy that's going to cobble together 10 or 20 of these, that's hard work and that's a pain. But if you get 20 of them, then it's interesting for a big private equity firm because then they can take that 20, pair it with their 20 and their 30 and their 50, and now you've got 100 of these things, and that's really interesting. The same thing happened and they're kind of getting hurt now, but during the great financial crisis, 2011, 2012, a lot of people went up and bought single family homes and turned them into rentals. But they were doing this on one-off things, like literally buying a house on the court doorsteps and then doing it. And then they had to manage it. And each house is different. It's a pain. But eventually these guys just grinded out and got to pretty big portfolios, and they sold them to Blackstone and Starwood. And I think it's called Signature Homes now, or it's a public company. So it's very relevant because a lot of people that I speak to, particularly on this platform, are looking at smaller deals, and there's an opportunity to cobble them into a collection that could be quite valuable. Belmont, one of the greatest hotel collections in the world, was one-off, two-off ins until they became the collection. The other thing that I think resonated with a lot of people is our focus on experiential and lifestyle hotels. And a lot of people that I saw at the conference were still focusing on the playbook that maybe worked, maybe didn't work over the past 10 years. And that's like value add acquisitions, repositionings of Marriott and Hilton hotels. And I think there's been a permanent shift in travel where a lot of those big hotels, think of an 800 room Marriott at the airport, that business model, I think, is actually obsolete. And I was telling my advisor today on the call, I said, if you take a DoubleTree in a secondary market and a Marriott in a secondary market and a Hilton in a secondary market, and they're all built in the 90s, they all kind of look the same, they're all run really well, and they've been renovated, but the outside of the building doesn't look anything special. Maybe they're near an airport, maybe they're near a college. The only way that those hotels are going to compete for business, assuming they're not like leisure focused, there's a mix of leisure, a mix of corporate, a mix of group, is on price because they are a commodity. And you're basically, if you're doing that, you need a salesperson to get the group business and the corporate business because that business just doesn't book online. You have to sell your ballroom space. You have to sell your room blocks. You have to sell your meeting space. And that's a big part of the business. How is that person going to outcompete the other three hotels when they all look the same? They all kind of serve the same purpose, and there's no differentiation. And essentially what you're doing is you're putting a $50 million asset in the hands of a $120,000 salesperson because so much of your business is coming from this person. And her only ability to get business is probably price driven. Maybe it's because they like her. Maybe it's because she's a good salesperson, but it's primarily price driven as opposed to a unique hotel, an experiential hotel that can get business because the hotel is cool and people have to be in this specific hotel because they cannot find it anywhere else. And that to me is a way safer investment, way bigger investment, way better investment than some of this other stuff. And that's what I mean when I think the world has shifted because people's preferences are not focused on those types of assets, and they're not interested to have their event or stay at that asset in all cases. Here's the big shift, okay? I was at the Breakers Hotel in Palm Beach a couple of weeks ago for a wedding. This is I think it's one of the best family resorts in the United States. This hotel makes so much money. They reinvest the money. It's owned by like a family trust. It is a phenomenal, iconic, once in a lifetime trophy asset. And they have great meeting space. They get like tourists, they get people there for corporate events, they get people there for weddings. Okay. I was there for a whole weekend. Every single night, all the ballrooms were filled with weddings and high-end corporate meetings. Okay. Those guests in that ultra, and it's not ultra luxury, in the luxury segment, the only place for those people to have their wedding and have their event is at a luxury hotel. They cannot do it at a barn. They cannot do it at a beer hall. They need to have their wedding at a luxury hotel because they expect a certain level of service and food, and they expect the rooms to be a certain way. So that luxury customer is staying there. They're not going anywhere. What about the customer right below them? What you would say is like a 3-4-star customer. Okay. Someone with taste, but middle market budget, right? Back in the day, they would have their wedding at the Hilton. They would have their corporate event at the Marriott. They would stay at the DoubleTree. But today, there's a lot more options. They can have their corporate event at some kind of cool experiential beer hall thing, a brewery, which is maybe more fun, that has a bowling alley in the back. They can have their wedding at a barn in the Texas Hill Country, and they can stay at a hotel down the street. You know, they could stay at an Airbnb. They can stay in this little cutesy boutique hotel. So that customer has many more options. And when you compare those options to like a DoubleTree or Marriott ballroom that hasn't changed in 20 years, like it's been renovated, but it's still the same shit, and it still feels like it did 10, 15 years ago, how are you supposed to sell that and compete with some of the other product out there? If you have really unique stuff and you have a great food, what is your competitive edge? Most of these hotels don't have a competitive edge. And I think it's going to be very, very hard to win and survive in that business going forward. And I also think some assets that people have bought recently, like here, let me show you one. Here's a big hotel company, MCR. They own a bunch of hotels. They own a mix of cool hotels. They own, let me actually pull up a different, okay, here we go. Here's like some random hotel website. Let's see if this loads. MCR buys Hyatt Regency O'Hare for an undisclosed sum. Let's just assume it was pretty cheap, but it's a big ass hotel. It is a, let's see, 1,000-room Hyatt Regency at Chicago O'Hare. Man, this is the hotel. I mean, that looks sweet. Like, if you are Google, are you going to want to have your big investor day at that hotel? Absolutely. Absolutely not. You're Google. Why would you ever have your investor day at that hotel? Well, I mean, it's Chicago. So I don't know. Let's pick some Chicago company. I don't even know. What would be a Chicago company? Like university. We're going to have our medical conference at this hotel. Well, it's by the airport. I guess that's kind of convenient. All the people could fly in and go there. Well, are we going to contrast that to like what other cool hotels are there in Chicago? Isn't like there the athletic club in Chicago? Like, isn't that a hotel? What is this thing called? Chicago Athletics? Yeah, this thing. Look at this. I mean, I could have it. Maybe it's not 1,000 rooms, but look, we could stay in this hotel. This looks pretty cool. Wow, this looks really cool. Okay. But, you know, this is 1,000 rooms. Who's having 1,000 rooms meeting anyways? It's rare. And if I'm doing it, you know, maybe I'm going to have it at the Miami Beach Convention Center. Okay. If you're having your big event at the Hyatt Regency in Chicago, it's probably a pretty low budget event. Okay. It's a commodity-based event. They are solely probably buying you based on price. Maybe they want a place that's in the middle of the country. I don't know. But look, $13 million renovation of its guest rooms in 2020, $13 million. That's nothing on a 1,000-room hotel. Like what is that? 13 million divided by 1,059. I think isn't that how many rooms is in this thing? 1,059. It's $12,000 per room. That's like not a lot of money. Okay. In a hotel that's 30 years old, it's not a lot of money. $13,000 a room. So that to me is very challenging. And then you also have to think, okay, you bought it cheap. Who are you going to sell that to? This is a 1980s like hotel. Who's going to buy that thing? It's a big old oil tanker. When a cruise ship gets like old and crappy, they kind of just like sink it. They retire it. They use it for scraps. They don't do that for buildings as much, but some of these hotels might be obsolete. So I think in that market, the upside is a lot of what you guys were talking about doing, what we're thinking about doing, what we're, we have a couple deals right now that we're underwriting, one that we're going to invest in. And that is where the upside, the opportunity is. Another key insight that I had on this trip is I think when I say leisure traveler, that's like a person that books like a one-off room for vacation, they're visiting family, maybe it's a business thing. That's like a leisure traveler. They are way more resilient than corporate and group travelers because that is very economy driven. And I want to have a hotel that has most of its business coming from those types of travelers because they just come to me online and they come to me through my website or through a booking engine. And it feels like less risk than relying on a salesperson to get 50% of my business from corporate or group. And the other way I'm going to mitigate against some of that is have smaller hotels. 1,000-room hotel. Like, how many times do you think that 1,000-room hotel is sold out? So if it's running 50% occupancy a year, that means 50% of the year the hotel is sitting empty. If you have a 100-room hotel, if you have a 60, 70, 80-room hotel, you could be running 80%. That means 20% of the year your hotels are sitting empty. That could be like, just on the crap night, like a Monday night or a Sunday night, maybe. Depending on the size of your hotel, like a friend of mine had like a 10-room hotel. It's not even really a hotel. It's like some shacks in the woods. And he almost had 100% every night, right? So you got to think about that. That was the rant. David, you got a question. What's up?
Yeah, I guess the classic argument with small versus large is the economies of scale, and I've heard a lot of people talking about how they're going to apply technology to lower the cost of operating these smaller hotels, especially kind of mid-tier properties. I know I've heard you talk about it before. I've heard you say different things about it. How much do you believe that?
Unless for me, which might not be the same for you or someone else, but for me that has a company that has millions of dollars in payroll at the corporate level, I need to produce enough revenue to cover that. But if you are a solopreneur and a one-off real estate guy, and basically the income of the hotel is what you're going to be happy to live on, might have a different answer. But if you want to grow a platform, be able to hire a team and scale this, what I would say is that the minimum would probably be 65 rooms that we would really look at, 60, 65 rooms, unless that hotel was doing over $1,000 in ADR. Because if you have a 30, like we're looking at investing in a hotel right now, that buying a hotel, that's like 30 rooms, okay? The ADR is over $1,000 a night, and the occupancy is almost 60%, okay? And it makes money today. Like it makes a lot of money. So the metric that I would look at is NOI, net operating income per room. So let's just say the hotel is doing, I think it's $1.8 million in net operating income. That's before debt service, okay? And let's say I think it's 30 rooms. So it's doing 60,000 of net operating income per room. I have hotels that are 300 rooms that are doing 15,000 of net operating income per room. So pound for pound, the other one's kicking, the ass of the big hotel that I have because it's generating the rate. Now, I could give you an example where you have a 30-room hotel that's bringing in nothing. It's all rate driven. You have to make sure your expenses, though, don't suck up all that rate. The other thing, David, so a buddy of mine he used to own a pretty big hotel in South Florida, like 200 rooms or something. He managed it like it was his investment, he and his dad, but he was basically running it day to day with a team, and it was part of Hilton. He sold it, they made money, and he loves the hotel business. So he bought a motel close to the beach, and he's trying to automate it exactly like what you said, David. Okay. So here's what he did. He got a PMS system called Muse. He has Salto as his like door lock manufacturer. It was already there. The hotel already existed. The real estate's expensive. I would say he potentially overpaid, but he has ideas to reposition and do whatever. But right now he's operating it as is. And it's very like mom and popish. Like, he shows me what he's doing. And I'm like, we would never do that in our hotels, right? But for this, it works because the expectations are aligned with what he's delivering. And it's a nice product. He has Diamo, which is Lifehouse's like revenue management technology arm, doing his revenue management. They made his website. He has a bookkeeper in India that's, and this guy ran a hotel, so he knows about P&Ls. Like he's basically the GM, okay? He has the bookkeeper, and then he hired like an engineering guy who's like a maintenance guy that comes there. He hired his old like housekeeping supervisor from his other hotel. She is the housekeeping supervisor and manages like the 2 or 3 other housekeepers they have. And here's where it gets into like very mom and popish territory. Okay. Very mom and popish. Like I wouldn't do this because I feel like I've grinded through all this crap, and maybe it's ego. Maybe it's just like I'm too old for this shit, but I'm not that old. So if a problem happens at the hotel, or if someone wants to contact the hotel, he has a system where it's this texting thing, and they all get it to their phones. It's like the head housekeeping. He has like a guy, I think, that's also working the front desk every once in a while, and him. And whoever, or no, it's like he has a remote worker in the Philippines. That's who it is. The housekeeper, the remote worker in the Philippines, and him. And whoever answers it first, like, answers it. And most things can be resolved through text message, but that's the management of the hotel. And it's completely automated. So you have a code to be let into like the office of the hotel, like the lobby. It's not like a real lobby, but it's a lobby. You make your own key, you check in, and then you go to your room. And that's it. And he told me that the first month I looked at the P&L, it was like 70% GOP. I think it was a 60% net operating income, like huge margins. Okay. He did like a decent rate. I'm like, well, how often do you go there? He's like, once a week. I'm like, what? I couldn't believe it. He's putting a lot of faith in that housekeeping person. Great, whatever. Okay. But it seems to be working. So
Thanks.
I'm open-minded, David. I'm open-minded. Now, he's operating this as kind of a bare bones hotel. Okay. If we were to do this in more of an interesting hotel, like with our style, with our infrastructure, where I'm not like the GM guy. Keep in mind, he doesn't have any like real payroll. Like it's all like hourly people, and there's no GM because he's the GM. But he's not even really the GM because he goes there once a week. If we were doing this, I think we could do a lot of the cool tech-enabled hotel stuff, but we'd have to layer in some expense to make sure we didn't lose our mind and to just give us some level of sanity because we want to hold ourselves to a higher standard. So like, we would not necessarily have like a housekeeping person responding to text messages at home and stuff like that.
It reminds me of there's a company called Cosat in New York. They've got a bunch of VC backers.
Yeah.
And what they're doing is very similar. Picking up existing kind of 100 to 200 room hotels in LA, and they just picked one up in New Orleans.
Yep.
And promising kind of similar 50-60% GOP margins. So far, I haven't seen them actually deliver anything like that, but they
Well, see, that's missing it, but they're a company. Like, I think it's very different when you're the entrepreneur and you're doing it yourself, Like he bought all the different parts and pieces and put it together, but he was the one that has to deliver for himself. I agree with you. I think it's harder when you're a company providing a service and trying to do that because there's expectations. Like if he hired a company to do it, some of the things that he's getting away with because he's doing it himself, he might not appreciate that the company's doing. That makes sense.
Yeah, that does.
Like he would maybe have the same level of comfort that it would get executed by the company in the same way that he has comfort because he's so closely involved. But I'm open-minded. I think it's very interesting. You know, I think the Diamo revenue management system is pretty basic, but if it's only transient, like maybe you can afford to be like maybe it's fine if it's basic.
Yeah, I mean, if you're competing on price already, then yeah, I mean that's an easier revenue management strategy, right? And then
That's very price driven and less strategic driven. Like, you know, it's our hotels, our revenue managers have a lot to think about. A, they have to think about what's going on in the market, but they also have to think about what's happening actually in the hotel. So, you know, if a salesperson books 50% of the rooms for some sort of group or a meeting,
Mhm.
the revenue management's going to change their strategy because now they have all this base occupancy locked in. That's not happening at this little motel. There's no one else booking business. It's all coming through the same place.
Would you say this comes down to like the entrepreneur, what's their exit strategy and what kind of stage they're in their life? Like I'm kind of inclining more like you. Like I think if he wants to keep it small and he doesn't care about driving the rate to the maximum, then you could have multiple of these and maybe you get to a certain scale where you have a GM and it becomes more like a legitimate business. Like it seems to me, I mean, I have like 25 Airbnbs and one small boutique hotel. And yeah, I have a GM. It got to a point, but I didn't want to be in the day-to-day operations. And in the small boutique hotel, we wanted to drive the rate up and we had to do it with some staff because at the end of the day, like the guest is walking in and they're like, okay, like what the hell is this? So if you have some staff, we went from having like 24-hour staff and security to slowly scaling it back to the point where people are there when now we figure out when the times where the guests needed the help and when they want to be left alone. And I think to a certain side, if you want to drive the rate up, I think you gotta have people. Like I just don't see people paying a premium because they could just go to an Airbnb, right?
Like I never stayed in Airbnb, I don't think. But I had stayed in vacation rental homes. The reason and Airbnb, I think, is adding something new, but the reason I haven't is because a lot of people don't take pride in the things that they do, or they're like just doing it to save a dollar everywhere. So like I feel like in some place, if you book through an Airbnb, like you're gonna get gross sheets, you're gonna get like crappy towels. You're gonna get like one towel per bathroom. You know, like the bare minimum. Kind of what I'm saying. Like obviously, there's Airbnbs that are not that way that are amazing, but I always think like the worst of people. And I'm gonna get the Airbnb with the guy gives me and my whole family one towel per kid, and that's what we're gonna get for our stay. And I'm gonna have to go out and buy towels down the street. So it's 100% what you're saying. And if you want to scale, you have to start to do things differently. And he wants to scale, but what he's doing right now is not scalable. And there's also some weird stuff like that wouldn't totally fly with me, but that maybe is flying with him because he's going to redevelop, like he's going to renovate this into like a much cooler, different thing. But so I saw him, I don't know, Sunday morning or something like that. And we were joking because I said, you got to love the hotel business because I spoke with someone on Saturday morning. We raised $6 million from that one person for a whole deal that we were doing, this preferred equity deal. And then I got off that, this is like 7:30 in the morning. I got off that call and I got a text from the president of our management company. And he's like, I got a call 5:30 in the morning that the sprinkler went off at this hotel and flooded rooms on the third floor. 15 rooms are like totally soaked. We have the remediation company coming in there. The good news is that it was only on the third floor and that the rooms below weren't damaged. Only the meeting space was damaged. The bad news is that I think our deductible is $500,000 and it's going to be well under $500,000. So we're going to have to, pay to fix all this crap and blah, blah, blah. So I'm like, that's the hotel business. You get the highs and the lows. You get, we get kicked right in the, the privates and you're smiling ear to ear, right? So, but then I went over to my friend's house and he's like, oh, I just got yelled at by a guest. Like I stupidly told her to, you know, ask for her number on the text messaging thing. And then I called her and then she yelled at me and she tried to ask for a free room. Like, well, what was she complaining about? What was the deal? And she said that there was like garbage or something, like a garbage bag left in the elevator in the motel. And she's like, I sent someone a message on the app that, hey, there's garbage in the elevator. And then I woke up the next morning, there was still the same garbage in the elevator. And my friend responded like, well, you know, you got to understand, we only have the housekeeping from like, I don't know, 12 to 6, and they didn't show up yet. And I'm like, that's kind of like, I was thinking to myself, like, it's a little bit of a lame answer. Then my friend's really smart and he's amazing. I'm like, that's not what the guest wants to hear. Right. And to your point, Juan, you know, another thing that I'm always worried about is, you know, bad things happening. And we have at all of our hotels security overnight, but this is like a 50-room hotel. You know, there's like corridors. It's not like a house, right? You're inside. How does he know there's not a crazy party at the pool? How does he know a guy didn't see a girl go into a room and ran over there and kicked in the door? You know, like not every hotel has security. That's a risk for everything. But there's no one in the hotel. So even if someone was screaming, you know, maybe you couldn't hear. You're basically like at an apartment building, which maybe is fine, but you know, hotels are more transient. So these are the things that you have to for sure consider and think about.
Sorry, I wanted to ask you, how important is it for you occupancy versus revenue? Like in my business, I'm like, we're struggling with this where I used to have like 85% occupancy. Now I have 60% and I'm making 20% more revenue. So it's like the dollar value looks better, but then my occupancy is down, which means my rates are going up, right? So at what point do you kind of say like, okay, I got to bring that occupancy up, or should I just be happy that I have more money coming in, you know?
So we predominantly focus on RevPAR, and we weigh that with a couple of things depending on the strategy, the market conditions, other things that might be going on at the hotel. So if you are running a luxury hotel and you're doing 99 or 95% occupancy, it's going to be really hard to execute because you're on all the time. Your housekeeping is constantly changing rooms, constant. There are people constantly going in and out of rooms. Your labor costs are going to go up. You know, every time you clean a room when a guest leaves, it costs more than if you clean a room in between a guest. So we think about it holistically, depending on what the strategy is at the hotel. Another thing that's, you know, important to think about is if you have restaurants and bars, if you have lower occupancy, that could actually make the revenue at those other outlets go down. But maybe if you had a higher rate, the people are actually spending more at the restaurant and the bar, and it balances itself out. Depending on the size of your hotel, the theory might be you want to book lower RevPAR rooms in early so that you have base business to then layer on top with higher rated business. One way that hotels do this is they contract with like airlines. So you have basically 30 nights or 30 rooms a night. You know you're going to be selling those rooms out. It's a lower rate, but it gets you closer to sell out for the rest of the people that will then charge or pay a higher rate. What we found though with the airline crews is a couple negative things can happen. One, your housekeeping costs are going to go up because they only stay one night. So they're going in and out of the rooms very quickly. The other thing is they don't go to your restaurants and your bars because they're working and they're exhausted from their flight and they really just go to bed. Maybe they grab a sandwich and that's it. So your incremental spend is not good. The other thing we found is they don't bring any life to the pool because they're not going to the pool because they're sleeping and working. So you really have to balance it across the board, but it's going to be supply and demand driven in your market. If your market has, weak demand, you're going to have to drop your rate to fill up the hotel. If your market has very, very strong demand, you can afford to charge as much the rooms as you can and kind of balance that occupancy as you get closer to a sellout. We measure something at our hotels called sellout efficiency. And actually, the last quarter four, we did a very bad job of sellout efficiency. We only achieved a sellout 14% of the times that we were close to selling out. So what that means is if our hotel is 95% sold, we want to try and sell those last 5% of rooms, because you can negotiate with someone, you can upgrade them to a room, you should try and sell the hotel out and manage that. And there's a couple of different ways to do it. Sometimes we oversell our hotels and then we have more drop off than we think. Sometimes the front desk people try and shut off inventory because they don't want to have a big rush. There could be a million different reasons why you don't achieve the sellout, but it really all depends. I mean, in New York, there's just so much demand that the hotels run a very high occupancy and a very high rate, but your rooms just get beat up a lot. So you have to be cognizant of that, and you have to be cognizant of the turnover. There's no right or wrong answer. There does get to a point where if your occupancy is so low, you really have to question, why do I own all this real estate that's not being fully utilized? So maybe there's a sweet spot around 70%. Maybe it's 80% in a more resort market. But if your annual occupancy is 50%, I think you really got to wonder, is my price causing that 50% occupancy, or is it just market? Like, no one wants to come here. Because that means 50% of the time for a whole year, half of my building is empty, but I'm still paying for the building. I own the building, but I'm only using half of it. Does that help?
Yeah, 100%.
Yeah. Yeah. So we had a conversation this week about one hotel where business has been tough, and they had resisted lowering the rate to a certain point, and the revenue team was like, listen, we're losing occupancy. Like, we're just going to drop it a little bit more and fill in some more occupancy because we need the top line revenue. Like, we need the revenue. We could try and flow that revenue, but like, we need the revenue. If we don't have the revenue, it's going to be worse on the bottom line. Like, let's get whatever we can get on the top line.
Number one, the kind of conversation on rise of experiential, both in the luxury segment and in this 3 to 4 star customer, has been on my mind a lot. And the hotel that I'm working on, I'm currently trying to set a target ADR for it. And it's a sister market. It's a smaller town outside of a highly trafficked market, Cabo. And so the ADRs there are a lot higher. There's a lot of large luxury hotels. And the project that I'm working on, I'm aiming more so, I think, to target the people who are not at the I only stay in luxury range, the people who will say, like, I will compromise on going to something ultra luxurious for something experiential. The challenge I'm having right now is trying to figure out how much of an ADR distance I want to create from my local market. I know I'm building what is going to be the best hotel in my town. And I'm kind of stuck between getting a bit closer to the person who is top of market right now and trying to see if I can essentially take away existing demand, or creating a much larger margin between that person and myself to really just put myself in a different level. When you're approaching investing or developing the hotel in a market where you know you're going to be the most premium player, how do you approach creating that delta and thinking about this?
This week, one of our hotels had a few rooms paying $1,000 a night, which is pretty cool, because I don't think that hotel has hit that ever. In this market, a lot of supply has come into the market, and I think has made rates lower than they should be. comparatively to like other regional markets. And there could be other reasons for that, but I think the supply is definitely a big component of that. In my mind, travelers today are focused on like cost versus experience and value, and they do that analysis, and they're less focused on like what is fair for this place. Does that make sense? Like,
Makes sense.
okay, so if you're paying $400 a night for a hotel, you're gonna like reference that not against the other hotels maybe in the market. You're more so gonna reference that against, when I'm traveling today, does that seem within line, cheap, expensive, whatever. And I think people are bringing kind of this global worldview to the place that they're coming. And the opportunity for you, if you're trying to be the premium player, is to make the hotel the destination and not the destination the destination. So I might challenge you to actually not peg against Cabo and to think about other hotels in markets where the market's like fine and cool, but people are going because the hotel and it's in a great town or a great place. Whereas I think a lot of people go to Cabo because it's easy to get to, and they say they go to Cabo and they like the town, and like they're going to Cabo and then they're going to find the best option in Cabo. For what you're doing, it seems like you might want to attract people to your place for the place, and they're going to be comparing you against other places, other hotels in different places. And
No,
not
exactly.
on like down the road.
Yeah. And that's where I
So I
think
wouldn't like really focus on like, so I hate talking about Amangiri, but like there were no $5,000 night hotels in Utah at that time. And the same owner that owns the Hyatt Place like 10 minutes away. They're not charging half the price of Amangiri for the Hyatt Place. The Hyatt Place is crushing it, but it's not like they're not pegging it off of it's a totally different thing. So I think you have to think in terms of the same way. If the other hotel is somewhat comparable, then I think you should think about what rate they're charging and evaluate that. But if it's not even in the same spectrum of what you're doing, it's just another hotel in the place, then don't even really think about that hotel. Think about other hotels that your customer would be considering going to when comparing to come to your hotel or another place. Does that make sense?
makes sense.
I heard a recent example of this because everyone always says Amangiri, but the Four Seasons in Koh Samui, Thailand,
Yeah.
where they're filming White Lotus season 3 right now.
Oh, really?
They're like typically I didn't see an ADR number, but they're I read an article that said like they're typically like $2,000 to $3,000 a night, which is mind blowing because I went to Koh Samui in like 2019. I think I spent $100 for like a beautiful hotel.
I bet you that hotel was $700 in 2019.
Yeah, exactly.
Four Seasons, meaning, like the appreciation has been crazy. And I think there's a lot of fatigue starting to set in too, because they remember what they paid 5 years ago and like not a lot's changed.
Mm-hmm.
But they're paying, David. The only reason they're rationalizing it is because they're like, well, I paid $2,000 a night to stay at this hotel in Paris or Europe. So I guess that's kind of like what luxury hotels are now. There was an article in the Wall Street Journal, like $1,000 is the new whatever. Like that's the normal for normal ADR now. It was never the normal ADR.
I had another question, Jake. Do any of your projects right now have residences in them? And what's your kind of just thoughts on this? I'm seeing a lot of it in Baja specifically, where it's like every luxury hotel is adding a residence portfolio, and a lot of independent boutique hotels are like immediately doing that to try and juice their IRRs. I'm just curious. I've never heard you talk about residences, and it's an area I'm trying to get up to speed on pretty fast.
In the United States, I think it's very difficult to build a luxury hotel in a top market without residences.
Mm-hmm.
So that's the reason why a lot of it's happening, because you can't justify building the hotel without the sale of the residences.
Mm-hmm.
And I think a similar thing is probably happening in your market and in Baja. And the other thing that's happening is there's just a huge demand for residences, and they have this land, they have the service, they have the amenities. They realize they could charge 2 times per square foot because they're associated with the hotel versus something like in a gated community that didn't have the hotel. So I think that's the reason. One strategy, you have to decide what you want to do, but one thing that you could think about if you have the land is to get the hotel right. And then if you get the hotel right, you can add residences. Once you already have a following, once people are into what you're selling, because, people want to pay you that value without having tried, what you're selling.
Yeah, the premium is associated with having seen the experience first.
Yeah. Like
On
Blackberry Farm, Blackberry Mountain, Blackberry Mountain was not the best example, but Blackberry Farm was really the in first. Then they sold residences once they had this cult following. And Blackberry Mountain leveraged Blackberry Farm to do residences in conjunction with the development of the hotel. Amans have residences. They do okay. Some of them do better than others. They always did it, but it might be good to get the hotel right and then add a couple residences.
Aside from outright kind of purchases where the ultimate buyer of the residence, right, just buys it outright, puts it back into the management pool, etc. Whether or not they want to do that is obviously up to them. Have you seen any other kind of interesting or compelling models coming up? I know, I think of when I was a lot younger and timeshares, and I know that still exists, but obviously generationally, I think that's not compelling.
That's real estate. I'm going to call it a scam. It's not a scam, but I'm going to call it a scam because it's amazing. Is fractional ownership of real estate.
Mm-hmm.
And the best example I've seen of an executed project is the Little Nell residences in Aspen, Colorado.
Mm-hmm.
So if you look that up, and they have the Little Nell Hotel, and then they built the Little Nell residences. And I'll do some math. So let's just say the numbers are way out of whack now, but let's just say in Aspen, a condo is $3,000 a foot for 100% occupancy. If you bought a random condo, it's $3,000 a foot. Okay. Yeah. So let's just say you bought 1,000 square foot condo. That's $3 million. Okay. What they kind of did with fractional is they say, well, you're going to have, and there's a couple different ways to do it, but in Aspen, you want to be there in the winter and you want to be there in the summer. So there were kind of these weeks or these 2-week periods that you could either get designated. I think in that one, you would buy the specific weeks that you want. And that's committed to you, guaranteed. There's no messing around. If you get 4 weeks in the winter and 4 weeks in the summer, and it's first come, first serve, you buy the weeks that you want. Okay. So let's just say there's 5 different people that buy the one condo. What happened here at the Little Nell is the people buying the 1/5 were paying $2,000 a square foot. Okay. So what they were really paying is $10,000 a square foot.
Mm-hmm. Yeah.
So the developer was, the market in town was $3,000 a square foot. This developer is selling for $10,000 a square foot. That guy's holding on the level.
Mm-hmm.
So that is an amazing strategy. And you can do it but me as the buyer, I'm just well, I'm only going to use it anyways 5 weeks out of the year. So I might as well buy this great unit and share the costs and have the ability to put it back in the rental pool. So you'll justify whatever the hell you want. But at the end of the day, you're spending $10,000 a square foot on the thing.
Yeah. And that's where I think on the type of repeat visitor that visits my market. It's a big wind sports destination, mountain biking, etc. There are people that are here every year and they come for a month at a time and they're here every year.
Well, the other thing you could do is build residences and not sell them and just rent them out for a month at a time and rent them out for 5 nights at a time. Rent them out for whatever you want.
Yeah. Great. This is helpful.
That's a huge, like a villa program is very popular at hotels. And then you get a family who pays a lot to have their own space.
Yeah. Makes sense.
Yeah.
I wanted to quickly ask you, when you were showing that hotel that you're gonna be staying at, and you see all of these amenities that they have. It looks like they have unlimited amenities that you won't even have time to like even use. It seems like that hotel's been there for many, many, many years, right? So now when you're looking to go and create a space like that or even buy a place like that, like how do you see that actually playing out in terms of like, okay, because that building itself looks like it has some historic appearance to it, and it's probably been there for many, many years. So like, let's say we're gonna go and like, attack a very similar strategy. Like, how long do you wait until you can build all these things and staff it and like get it to the point where it can get to that level?
So I need to get more knowledgeable about the background, the story, but believe it or not, I think this is only like 2 years old. The building is older. It was like repurposed or whatever. I don't know what it was before. It was obviously a house before, but I don't know what, maybe it was an interim use. I don't know what they were doing with it. This is only like, I think 2 or 3 years old. It's very new. I mean, they have like you're saying, there's like many things, like you drive a baby Land Rover around. Okay. They like so much stuff to do. Let me see if there's like falconry, like all this cool stuff. And it is an endless list of activities. So, I didn't say this hotel was making money. That's one thing. But I think part of how they're able to justify it, Juan, is they're adjacent to London. They're an hour and a half outside of London, and they're selling memberships. And I haven't been there, but I would assume there's a lot of people that have country houses that they go to on the weekends that are near here, and they're using this almost like a country club. And that's probably subsidizing a lot of the cost. The reason why membership clubs are getting so popular is because it's like guaranteed income that you can use to subsidize a lot of things.
I saw a similar model in Isabela, Puerto Rico. They had 20 units. It was like a valley style on a cliff on like a massive piece of land, and it was $500 a night. I did the math: 500 times 20 times this. I'm like, where is the money coming from? And they had a massive golf club with and it was like $100,000 membership, and I was like, okay. Yeah, they ended up. So I was. My last question is, when you think of like acquisition and maybe bolting all the smaller units, how do you think about the exit? Because I'm thinking about, depending on the market, who's really gonna be the buyer that wants this. I kind of feel like I agree with the play. I'm curious, like if you haven't seen a buyer coming in and buying, like a conglomerate of smaller hotels, is it kind of like a speculative move, or do you think that? How do you see that?
Well, I mean, ultimately, you could create your own brand. And the brands like Hilton and Marriott have acquired some lifestyle properties recently. AutoCamp, Getaway, the trailer thing. I don't think they were like successful executions on the owner side necessarily, but I think it's more probably because they raised too much money and like the business plan was a little messed up. But Graduate Hotels was another one. Like there is a lot of value in scale and having a portfolio. So if you can grind through and put this thing together, it adds up to real money and becomes very valuable. But it could also be valuable to you to create a brand. I mean, when Hilton or Marriott started, it was just a bunch of Marriott hotels, and that became the brand in the portfolio. So the exit could be no exit. It could be an exit to a larger player. It could be an institutional investor. Amman is the same thing. Belmond is another one. LVMH bought Belmond. I think they got it was like a steal, honestly. I think too many people missed the quality and the opportunity. I don't know enough about the economics, but you have trophy assets primarily in Europe that are unbelievable. Maybe they have some cost challenges. Who knows? But rates have also increased. Maybe LVMH brings something. They now have a collection of multiple brands in their luxury portfolio that's unmatched across the world. And that has a certain level of value to their stockholders. It's a public company. Also,
Thank you.
collections could be valuable to a number of people. Another way it could be valuable, one is, let's just say someone wanted to create their own brand. They could buy all your hotels and slap that brand on it. And now they have a portfolio of 20.
I'm sending out a newsletter right now. I think I'm about probably 6 months from my raise for this project. Goal is to send one out monthly. I just want to know from your perspective, assuming that there's a lot of these that hit your inbox, what's the difference between one that is good versus excellent in terms of the information that you're seeing and what's being kind of revealed?
I think a newsletter is different from actual when you're ready to raise capital. I think a newsletter should be very clear and succinct to what you're trying to do, how you're differentiated, and what your competitive edge is, and less technical about like the property and the project. And you want to come across as someone that's done the homework and that's an authority. And I would say it should have a lot of pictures, a lot of like, why is your place so special? Why are you so special? Why is your experience going to be so special? What are the things that you're going to do that's going to differentiate you? That I think is cool. I think people less care about like technical construction things or something like that.
Cool. In line with what I'm, so thank you.
Yeah. Yeah. I mean, I'll share like our memos. We've spent a lot of time on them, and I think I've gotten them to a really good place. They're very short, a lot shorter than you would see from many other people. But one of the things we've spent a lot of time doing is focusing on articulating why we like a deal. So we call it's the why we like it section. And it's 4 to 6 bullets of why we like a deal. Or like put another way, like why you should invest, or why this is unique, why this is special, why I'm doing it, the why. And being able to clearly articulate that and explain it in simple terms. I'll leave you one piece of homework. The All In podcast is a podcast I listen to. They recently had the founder of Uber on the podcast, Travis Kalanick, and a friend of mine works closely with Travis, but I don't know him. I haven't met him, and he hasn't really spoken publicly very much. He left Uber and started this company called Cloud Kitchens. Okay. Doesn't matter what they do. You'll figure it out when you listen to the podcast. Listen to the first part of when Travis comes on and explains Cloud Kitchens. Okay. Use that as inspiration to explain and tell people what your investment and what your idea is. I never heard, maybe there's like, very few people that can articulate a business plan so simply and succinctly as well as this person. Like, you talk about a 1-minute elevator pitch. This guy's got the 30-minute elevator pitch, and then you're or 30-second elevator pitch, and you're spending 30 seconds writing out the check. It is very crisp and clear. And that's what you want to try and get to.
Hey everyone, it's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter at @JWurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.